The Federal Reserve, as the custodian of America's monetary policy, finds itself embroiled in a pivotal struggle against surging inflationary pressures. With inflation metrics soaring to heights unprecedented in recent memory, the imperative to rein in these escalating price levels has become paramount. Fed Chairman Jerome Powell's resolute stance underscores the gravity of the situation, as he underscores the necessity of implementing stringent measures to curb inflation, even at the expense of enduring economic discomfort. However, the pivotal question looming over financial markets and policymakers alike revolves around the extent and duration of the Federal Reserve's interest rate adjustments. The dichotomy between Wall Street analysts' projections and the Federal Reserve's official stance has widened in recent times, reflecting the complexity and uncertainty surrounding the central bank's policy trajectory in the face of mounting inflationary pressures. As the Federal Reserve grapples with the formidable task of taming inflation, the divergence in views between market participants and central bank authorities adds a layer of intricacy to the unfolding economic landscape. While Wall Street analysts scrutinize economic indicators and scrutinize the Federal Reserve's policy signals for cues on interest rate trajectories, the central bank faces the formidable challenge of striking a delicate balance between inflation containment and sustainable economic growth. The evolving dynamics of inflationary pressures, coupled with the unpredictable interplay of global economic forces, render the path forward for monetary policy fraught with uncertainty. Against this backdrop, the Federal Reserve confronts the daunting task of navigating the intricate web of economic variables to chart a course that fosters stability and resilience in the face of mounting inflationary headwinds. The Federal Reserve's unwavering resolve to confront inflation finds its roots in the economic tumult that gripped the United States during the 1970s and 1980s. Renowned for his bold and decisive actions, former Fed Chairman Paul Volcker stands as a testament to the central bank's commitment to combating runaway inflation. Volcker's unprecedented decision to raise interest rates to staggering heights, peaking at a staggering 20%, aimed to decisively break the vicious cycle of spiraling price levels. While the ensuing severe recession inflicted considerable economic hardship, Volcker's resolute approach ultimately proved effective in wresting control over inflationary forces, laying the groundwork for restored stability and confidence in the economy. The enduring legacy of Paul Volcker's tenure at the Federal Reserve serves as a poignant reminder of the pivotal role played by decisive monetary policy action in taming inflationary pressures. The drastic measures undertaken during that period underscore the Federal Reserve's steadfast commitment to prioritizing long-term economic stability over short-term fluctuations. Volcker's bold strategy, though met with initial skepticism and hardship, ultimately served as a catalyst for restoring confidence in the economy and cementing the Federal Reserve's reputation as a guardian of price stability. Fed Chairman Jerome Powell's resolve to confront inflation stems from a profound apprehension regarding the repercussions of prematurely easing the fight against inflation, reminiscent of the challenges faced during Paul Volcker's tenure in 1980. Powell is acutely aware that a premature relaxation of monetary policy could potentially reignite inflationary pressures with even greater ferocity, thereby exacerbating the economic landscape. In his quest for long-term economic stability, Powell seeks to attain a terminal rate of interest, a threshold where interest rates are elevated sufficiently to catalyze a natural decline in inflationary forces, obviating the need for further rate hikes. Driven by a commitment to learn from past mistakes and chart a course towards sustained economic equilibrium, Powell's strategic vision underscores the delicate balance between curbing inflationary pressures and averting adverse economic ramifications. By aiming to establish a terminal rate, Powell aspires to orchestrate a gradual and controlled descent of inflation, ensuring that the economy navigates through challenging terrain without succumbing to the pitfalls of past inflationary episodes. Through prudent monetary policy adjustments and forward-looking strategies, Powell endeavors to steer the Federal Reserve toward a position of strength, equipped to withstand the complexities of the evolving economic landscape while safeguarding against the resurgence of inflationary pressures. Amidst the ongoing discourse surrounding the Federal Reserve's monetary policy, a growing chorus of voices on Wall Street advocates for a shift in the central bank's approach, suggesting that the Fed may have either reached or approached the so-called terminal rate. These analysts assert that the economy is exhibiting signs of deceleration, with the specter of an impending recession looming on the horizon. Their contention lies in the premise that the natural course of economic cycles, coupled with the waning momentum of economic growth, is poised to exert a cooling effect on inflationary pressures, thereby alleviating the need for further aggressive interest rate hikes. In light of these perspectives, proponents of an altered monetary policy stance contend that persisting with additional interest rate hikes could exacerbate the economic downturn, potentially plunging the nation into a deeper recessionary quagmire. Consequently, they advocate for a timely recalibration of the Fed's approach, emphasizing the imperative of adopting measures that align with the evolving economic landscape. As the debate intensifies, the Fed faces the challenging task of navigating between the imperative to combat inflation and the necessity of averting an economic downturn, underscoring the delicate balance between proactive policy adjustments and the preservation of economic stability. A key point to understanding the debate is the difference between supply-side and demand-side inflation. Supply-side inflation is caused by disruptions or shocks to the supply of goods and services, such as those caused by the pandemic and the war in Ukraine. Demand-side inflation occurs when consumer demand significantly outstrips supply, leading people to bid up prices as they compete for goods and services. The current inflation surge was initially driven by supply-side factors. However, the Fed sees signs that the inflation problem may be shifting to become more demand-driven. Powell remains wary because if consumers begin to expect inflation to persist, they will spend money more quickly, anticipating that prices will keep going up. This can create a self-fulfilling cycle. The Fed's persistence in combating inflation carries significant risks. While inflation is undoubtedly harmful, aggressively driving up interest rates can choke off economic growth and cause widespread job losses. This is the pain that Powell has warned about. However, failing to bring inflation under control also has dire consequences. Historically, runaway inflation has led to economic instability, social unrest, and the erosion of confidence in government institutions. In severe cases, it can even destabilize entire societies. The Fed is likely to raise interest rates a couple more times, perhaps reaching the 5% to 5.25% range. After that, the Fed is expected to pause and wait to see how the economy and inflation respond. In the scenario where inflation exhibits signs of abating, the Federal Reserve may opt for a cautious approach, refraining from additional tightening measures in pursuit of what economists term a soft landing. This desirable outcome entails a gradual moderation of inflationary pressures without precipitating a pronounced economic downturn. By carefully gauging the trajectory of inflationary trends, the Fed aims to strike a delicate balance, steering the economy towards a state of equilibrium where inflation is reined in without triggering adverse repercussions on economic growth and employment. Conversely, if inflation persists at elevated levels, the Federal Reserve could find itself compelled to implement further interest rate hikes to counteract inflationary pressures. Such a scenario would underscore the pivotal role of monetary policy in managing the macroeconomic environment and preserving price stability. Given the interconnected nature of the global economy, the implications extend beyond the borders of the United States, potentially impacting international financial markets and economies worldwide. As policymakers navigate these complex dynamics, the economic stakes remain exceedingly high, with the potential to shape the trajectory of both domestic and global economic landscapes. Economic forecasting is notoriously difficult. The Fed, like all market participants, operates with imperfect information and within complex systems. It's possible that both the Fed and Wall Street could be wrong in their analyses and the trajectory of inflation could surprise everyone.